everybody, and welcome to another episode of Real Talk, where real agents answer real questions about real estate. My name is Tyler Nowak.
My name is Zach Sadler, and we both work for estate professionals based out of Longmont, Colorado. Today's episode, we're going to be discussing what private mortgage insurance is, who pays it, why do we need it, and why it's a part of our loans. So today we're going to be breaking down the difference between mortgage insurance for conventional loans and FHA loans.
Right, exactly. So let's start with what private mortgage insurance is. It's a type of insurance that protects the lender against borrower default. What borrower default means is as a borrower, if you're not able to make your monthly payments on your loan, then you have defaulted on your loan payments.
For a conventional loan, you have to pay this mortgage insurance if you're putting less than 20% down. But for an FHA loan, you'll have to pay this insurance throughout the entirety of the loan. Now, a down payment is the amount of money, of your own personal money, that you bring to closing. And it's a common misconception that you need 20% to even qualify for a loan, but that's just not true. For a conventional loan, you can put down as low as 3%, and an FHA loan, you can put down as low as 3.5%.
If you're thinking about putting down less than 20% on your loan, then you should be aware that that private mortgage insurance is going to come into play. That's because if you're putting down less than 20%, in the lender's eyes, that there's a higher chance that you could default on your loan payments. So they want to make sure that they're insured just in case that happens.
Exactly. And so for a conventional loan, these mortgage insurance payments are built into your already mortgage payments that you have. Whereas for an FHA loan, you have to pay a mortgage insurance premium, which is at the start, kind of like a startup fee. But then there's also a percentage that is incorporated to your monthly payments.
The great thing about private mortgage insurance is, yes, it might sound unnecessary at first, but if you're looking to buy a home without a 20% down payment, it gives you the opportunity to get into a home earlier and start building equity in your own name.
All right, here's a quick example going over the difference in down payments you can make and how that affects your monthly mortgage payments, and also how appreciation factors into that equation. So for this example, we're going to be looking at a house that's priced at $400,000. And assuming that you're going to need financing, we're assuming a 30-year loan with a 4.1% interest rate. Now, if you wanted to put 20% down for this house, it would be $80,000. But say you don't have enough money to put that amount down, and you want to do something more similar to a 5% down payment at $20,000. When you put that 20% down, your principal and interest payments are going to be $1,546. Now, this does not include the mortgage insurance. One, because it's at that 20% down, so you don't need it, but also because it's factored by your credit score and other individual things where we don't want to assume it in this situation. So like I said, your monthly interest and mortgage payment is going to be $1,546 for the 20% down. And it's going to be $1,836 for the 5% down. Now that's a $290 difference between putting your 5% down and 20% down. When you times that out by 12 to get your annual amount, with 20% down, it's going to be $18,552. With 5% down, it's going to be $22,032. For an annual difference of $3,480. And this number is just the difference between putting your 20% down and 5% down, and that 290 times 12. Now, if we fast forward a year and look at this again, we're going to be comparing on the left here, you purchasing that house for the 5% down, opposed to waiting one more year to try and save up to get to that 20% down. When you have that 5% down, your payments are $1,546, like we said. But in Colorado, where we're at, houses are usually appreciating by 5% a year. So that $400,000 house a year later would be $420,000. Now, that's going to increase your down payment if you still want to do that 20% by $4,000, when previously it was at $80,000, now it's $84,000. And then that's also going to slightly increase your principal and interest payments from $1,546 now to $1,589. Now, the big difference here is when you purchase that home a year earlier, that appreciation goes into your pocket as equity in your home. But now, if you waited 1 year, that appreciation has made the price of the home more expensive, making your down payment more expensive and your principal and interest payments more expensive as well. But another interesting factor to consider is if you're currently renting at, say, $1,500 a month, if you wait 1 more year and are renting for that time, that 1,500 times the 12 months is going to be another 18,000. So by waiting 1 year, you have the potential to miss out on almost 40,000 between these two factors right here. And that rent is just going to be another expense when you could be spending money towards your mortgage to build up equity. So when you put that together and compare the mortgage difference of 3,480, like we figured out from the previous page, and compare it to the amount you could get in equity from appreciation and how much you'd be spending on rent, sometimes it's not the best option for you to wait to get that higher down payment.
Well, that was another episode of Real Talk. We hope that you guys found this video helpful. Our contact information will be in the description below, and make sure to leave any comments or questions if you have them in the comment section.
Yeah, and then until next time, we'll see you guys next week, and thanks for joining us on another episode of Real Talk.